Hey there, future investor. Ever wondered how some people seem to turn a few bucks into a fortune with the stock market? Maybe you've heard the success stories of people striking it rich, or maybe you've just wanted to take control of your financial future. Either way, you're in the right place. In this video, we're diving into the beginner's guide to stock market investing. How to get started. Before we jump in, make sure to hit that subscribe button and give this video a thumbs up. Trust me, you won't want to miss any of the tips and tricks we're about to reveal that could set you on the path to financial freedom. 1. Why invest in the stock market? The power of compound interest. Let's kick things off by talking about why the stock market is such a powerful tool for growing your wealth. It's not just about buying low and selling high. One of the key benefits of investing in the stock market is the magic of compound interest. Imagine your money growing on its own, and then that growth growing even more. That's the essence of compound interest. It's earning returns on your returns. Over time, this can lead to exponential growth in your wealth. Beating inflation. Another compelling reason to invest is to beat inflation. If you keep your money in a regular savings account, you might actually be losing purchasing power over time. Inflation, which is the gradual increase in prices, erodes the value of your money. Historically, the stock market has provided returns that outpace inflation, meaning your money grows instead of shrinks. 2. Understanding the basics. What is a stock? So, what exactly is a stock? A stock represents a share in the ownership of a company. When you buy a stock, you're buying a small piece of that company. This entitles you to a portion of the company's profits, typically paid out as dividends, and it gives you a vote in certain company decisions. The stock market. The stock market is where these shares are bought and sold. Think of it as a giant auction house, where buyers and sellers come together to trade shares at agreed-upon prices. The two most well-known stock exchanges in the United States are the New York Stock Exchange, NYSE, and the NASDAQ. But there are many other exchanges around the world. Types of stocks. Stocks can be categorized in various ways, but two of the most common types are common stocks and preferred stocks. Common stocks are what most people think of when they talk about stocks. They offer potential for capital appreciation and usually come with voting rights. Preferred stocks, on the other hand, often pay higher dividends but don't typically offer the same potential for price appreciation or voting rights. 3. Getting started with stock market investing. Set your financial goals. Before you even think about buying your first stock, it's crucial to set clear financial goals. Are you investing for retirement, saving for a major purchase, or just looking to grow your wealth over time? Knowing your goals will help you determine your investment strategy and time horizon. Determine your risk tolerance. Next, consider your risk tolerance. How much risk are you willing to take? Stocks can be volatile, and prices can go up and down. If you're someone who loses sleep over the idea of losing money, you might want to stick with more conservative investments. On the other hand, if you're willing to take on more risk for the chance of higher returns, stocks might be right up your alley. Open a brokerage account. To start investing in stocks, you'll need to open a brokerage account. This is an account that allows you to buy and sell stocks. Many brokerages today offer low or no commissions, so you can start investing with just a small amount of money. Look for a brokerage that offers a user-friendly platform, educational resources, and solid customer service. Research and choose stocks. Once you've opened your account, it's time to start researching stocks. This is where the fun begins. Look for companies that have strong financials, a competitive edge, and a history of growth. You don't need to pick the next Amazon or Google to be successful. Even well-established companies can offer steady returns over time. Diversification. One of the golden rules of investing is diversification. Don't put all your eggs in one basket. By spreading your investments across different sectors and industries, you can reduce your risk. If one stock underperforms, your other investments can help cushion the blow. 4. How to analyze stocks. Fundamental analysis. Fundamental analysis involves looking at a company's financial health and performance to determine whether it's a good investment. Key metrics to consider include revenue, profit margins, and earnings per share, EPS. You should also look at the company's balance sheet, which shows its assets, liabilities, and shareholders' equity. Technical analysis. Technical analysis, on the other hand, focuses on price movements and patterns. By analyzing historical stock prices and trading volumes, technical analysts try to predict future price movements. This approach is more about timing your trades than evaluating the long-term value of a company. Key ratios to know. There are several key ratios that can help you evaluate a stock. The price-to-earnings (PE) ratio compares a company's stock price to its earnings per share, giving you an idea of whether the stock is over or undervalued. The debt-to-equity ratio helps you assess how much debt a company is using to finance its operations. And the return on equity (ROE) shows how efficiently a company is using its equity to generate profits. 5. Common investing strategies. Buy and hold. The buy and hold strategy is one of the most straightforward and popular investing strategies. As the name suggests, it involves buying stocks and holding on to them for the long term, regardless of short-term market fluctuations. The idea is that over time, the market tends to go up, and by holding onto your investments, you can ride out the ups and downs. Dollar cost averaging. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of the stock's price. This strategy helps reduce the impact of market volatility by spreading out your purchases over time. You'll end up buying more shares when prices are low and fewer when prices are high, potentially lowering your average cost per share. Growth investing. Growth investing focuses on companies that are expected to grow at an above-average rate compared to other companies. These companies often reinvest their earnings into the business to fuel further growth rather than paying out dividends. While growth stocks can offer high potential returns, they also come with higher risk. Value investing. Value investing involves looking for stocks that are undervalued by the market. Value investors believe that the market overreacts to good and bad news, leading to stock prices that don't accurately reflect a company's true value. By buying stocks at a discount, value investors aim to profit when the market eventually recognizes the stock's true worth. 6. Managing your portfolio. Monitoring your investments. Once you've built your portfolio, it's important to monitor your investments regularly. This doesn't mean checking your stocks every day, but you should stay informed about the companies you've invested in and any major market news that could affect your portfolio. Rebalance your portfolio as needed to ensure it aligns with your goals and risk tolerance. Knowing when to sell. One of the hardest parts of investing is knowing when to sell. You might sell a stock if it no longer fits your investment criteria, if you need the money, or if you've reached your financial goal. However, it's important not to let emotions drive your decisions. Just because a stock's price has dropped doesn't necessarily mean you should sell. On the flip side, don't get too greedy. Sometimes taking profits is the right move. Reinvesting dividends. If you invest in dividend-paying stocks, consider reinvesting those dividends. Many brokerages offer dividend reinvestment plans, DRIPs, which automatically use your dividends to purchase more shares of the stock. This can help accelerate the growth of your portfolio over time. 7. Avoiding common mistakes. Chasing hot stocks. It's easy to get caught up in the hype of a stock that's skyrocketing in value. But chasing hot stocks can be risky. Often, by the time you hear about a stock's rapid rise, much of the potential profit has already been realized. Instead of chasing the next big thing, stick to your investment strategy and focus on the long term. Overtrading. Overtrading is another common mistake among new investors. The temptation to constantly buy and sell stocks can lead to high transaction costs and poor investment decisions. Remember, investing is a marathon, not a sprint. Patience and discipline are key to long-term success. Letting emotions drive decisions. The stock market can be an emotional roller coaster. When stock prices fall, it's natural to feel anxious or even panicked. But selling in a panic can lock in your losses. On the other hand, fear of missing out, FOMO, can lead to buying at the peak of a market rally. Keeping your emotions in check and sticking to your investment plan is crucial. 8. Leveraging tools and resources. Utilizing investment apps and platforms. In today's digital age, investing has never been more accessible. Numerous apps and platforms are available that cater to both beginners and seasoned investors. These tools often offer features like real-time stock tracking, educational resources, and automated investing. Apps like Robinhood, Webull, and eTrade provide easy-to-use interfaces and low fees, making it simple for newcomers to start investing. Additionally, Platforms like Betterment and Wealthfront offer robo-advisors that automatically manage your investments based on your risk tolerance and goals. Taking advantage of educational resources. Knowledge is power when it comes to investing. Many brokerage platforms offer a wealth of educational resources, including webinars, tutorials, and articles to help you build your investing knowledge. Websites like Investopedia and financial news outlets such as CNBC and Bloomberg are also great sources for staying updated on market trends and deepening your understanding of investment strategies. Joining investment communities. Another valuable resource is the community of fellow investors. Online forums, social media groups, and platforms like Reddit or /investing or StockTwits allow you to connect with other investors, share insights, and learn from their experiences. While you should always do your own research, these communities can be a great source of tips, advice, and support as you navigate the stock market. Using stock screeners and analysis tools. Stock screeners and analysis tools are essential for identifying potential investment opportunities. These tools allow you to filter stocks based on criteria like market capitalization, PE ratio, dividend yield, and more. Popular screeners like Yahoo Finance, Finviz, and Morningstar offer free versions that are more than sufficient for most beginners. Keeping a trading journal. Finally, consider keeping a trading journal. Documenting your trades, the reasons behind them, and the outcomes can help you identify patterns in your decision-making process. Over time, this practice can provide valuable insights into your investing behavior, helping you refine your strategy and avoid repeating past mistakes. Conclusion. Congratulations! You've taken your first step toward becoming a savvy investor. By understanding the basics of stock market investing, setting clear goals, and staying disciplined, you're well on your way to growing your wealth. Remember, the key to successful investing is patience, research, and a long-term perspective. If you found this guide helpful, don't forget to hit the subscribe button and give this video a thumbs up. We're here to help you navigate the world of investing with more tips, strategies, and insights, so stay tuned for more content. Thanks for watching, and happy investing.